Welcome to Global Money Talk, brought to you by Sempro TV. Greetings to all of our viewers from across the U.S., Korea, and around the world. We're coming to you live from the floor of the New York Stock Exchange in New York City, the financial capital of America. I'm Remy Blair, and joining me today at the New York Stock Exchange is Dan Ha, partner at Karani Asset Management. Dan, happy Friday. Thank you so much for joining me.
Happy Friday. Glad to be here. Thank you.
Well, today does mark the final trading session for the final full trading week of 2024, since we do have a holiday shortened week next week and the week after that. So we saw plenty of volatility across the market this week. So where do you stand?
Sure. Yeah, I mean, Wednesday was pretty violent. And so this week, I was watching yesterday really closely, actually, to see how the market would behave, following Wednesday's move, which was something like, I think it was actually the second worst day for the S&P 500 this year. We didn't get a bounce yesterday. Today it seems like we are. It didn't start out that way, but we are, which is pretty encouraging, actually. This so far, I think it's interesting. As of now, the S&P equal weight and the Russell 2000, which looked like and were outperforming the S&P 500, the cap-weighted S&P 500, by a pretty wide margin following the election. On the optimism is now underperforming the S&P 500. I didn't think it was a good idea to chase, post-election rally. I still feel the same way. I'm still not interested in really, chasing binary bets. What I mean by that is, heads I win, tails I lose type of situations. Just if you think back a couple of weeks ago, it was kind of hard to find anyone that was bearish. I think the optimism, or generally speaking, I think mood was really rather optimistic. But I always remind myself of the Lloyd Blankfein quote. Lloyd Blankfein, the former CEO of Goldman Sachs, who said that things are never as good as your best hopes, and never as bad as your worst fears. And so when the mood is really optimistic, when it's hard to find bearish views, markets making new highs, it helps to be cautious. I do think that the Trump administration is going to be very pro-business. So that ought to be good for American companies and the U.S. economy. But the only thing I'll say about that is, if the Trump administration is promising, say, 100, I think the reality, we'll have to see how much of that actually comes through. So there are lots of things that he wants to do, which, if they all happen, would be great. But if they're promising, if he's promising 100. The reality is that it's probably, what actually gets delivered is probably something, some level lower. I don't know how much, but maybe what we're seeing with the budget right now is maybe a preview of the reality of trying to do everything that you want to do. What made Wednesday such a bad day was, the Powell's hawkish tone was unexpected. Markets were expecting more rate cuts, and it looked like that wasn't what the Fed was thinking. And so what do we have? We have a situation, an environment where inflation looks like it's kind of stubborn, although today's PCE data perhaps says otherwise, which is why I think the market's probably responding pretty well, along with the consumer sentiment. But so we'll have to see. But if inflation is sticky, labor market's cooling, it's not a good combination. And so we saw how violently the market could react to fewer rate cuts, or even an indication of fewer rate cuts. But if you think about the policies, I think it's largely agreed that these pro-growth policies, pro-business policies, are largely inflationary. So, if you want to have a situation where, you have high growth, low inflation, low interest rates, lower taxes, I don't know. To me, it feels like something's got to give. It doesn't have to. It is possible that we get, all of those positives in one nice package, and that's what drives the U.S. economy over the next several years. It's possible, but realistically, I feel like something's got to give, and the reality is that no matter what you choose, it's not going to be. It's not going to be good for either. Not going to be good for the economy, or not going to be good for the stock market. I feel like you can't have it all. So it's kind of like picking poison. You're just going to have to pick. Hopefully you'll pick the lesser one, but poison's still poison. And so I feel like right now there are lots of ways for market to be disappointed, which is not really a good. Which is not really a good setup.
And Dan, I think that Lloyd Blankfein quote is poignant, especially as we head into year end. And as you mentioned, there are so many moving parts here. And when we talk about the volatility we saw earlier this week on the heels of that Fed rate decision, it wasn't just the decision, of course, it was the projections, the summary of economic projections, as well as the comments from Powell. So considering that today we are seeing the market trying to turn around and pare back some of those losses. As you mentioned, we did get quite a surge in the major equity averages and riskier assets as well, including Bitcoin post-election. But I think when it comes to sentiment, as well as what we're seeing in terms of performance for the equity averages, understanding that there's a rotation and perhaps looking at the equal weight, as you mentioned, is key here.
I mean, just to add to that, last week I talked about how sentiment can change really quickly. That's something that I always keep in the back of my mind as an investment, as an investor. Moods can change so quickly that it's important to not be too extremely positioned one way or another most of the time, because when you get a reversal, and often they happen really quickly and could happen very violently. So I think it's good to keep that in mind.
And as you mentioned, if we take a step back, we know that expectations do not necessarily mirror reality, as you said. And when we look at the Dow Industrials performance this year to date, we are still higher. And when we did see that pullback by over 1,000 points earlier this year, particularly August 5th, we saw the VIX skyrocket versus on Wednesday the VIX did rise, but not to the same extent as it did back then. Yeah, and as we head into year end, of course, there are expectations for the new year, 2025, which is right around the corner. So what are your thoughts heading into the new year?
So I don't know if I sounded very optimistic in my first response, but I'm generally cautious. It's part of it is personality, but I'm also not. I'm a risk reward guy. I'm not a bullish, bearish guy. So that continues to be my focus. Continuing to look for the best risk reward opportunities that we could find, which you can still find, in this market. But more specifically, I think for us at least, all the things that I talked about earlier in the show, to answer to your first question, just kind of keeps us focused even more on quality and valuation as we head into 2025. We're not changing our strategy dramatically. We're not changing the investment philosophy, the kinds of things that we look for. Companies that are really well run, has an outstanding corporate culture that's a differentiator, a competitive advantage for the company. We're long-term investors. We're not really changing that. But having said that, it is just given all the risks in the market and how quickly things can change. I am incrementally more focused on, like I said, higher quality and low valuation. That could mean that could mean the portfolio getting sort of more concentrated around higher quality companies. Like I'd rather go into, for me, I'd rather go into 2025 with fewer higher quality names in the portfolio than lots of sort of okay quality names. So you might see that play out in my portfolio, or I might do that going into 2025. But of course, things change, and my job is to adapt to the changing environment. So that may change, but based on what I know now, just given the fact that I see so many ways that the market could get disappointed, I'd rather focus on, if you think about it, concentrating is a risky move. Generally speaking, the more diversified you are, the less risky. But under certain circumstances, if you could concentrate on the highest quality names, that perhaps actually, could actually, the quality aspect could counter the concentration aspect within the portfolio. So that's something that my team were thinking about right now.
And so building on what you just said, I think this is a good time to pause and talk about food for thought, especially with the holiday season upon us. So what would this actually look like for you?
Sure. So I actually brought some charts. These are charts that, can we pull up the charts, please? These are charts that I saw earlier in the week that served as good reminder on the sort of dangers of making overly optimistic assumptions. So it kind of goes together with the quote that I started with, right? Things are never as good as your best hopes, and never as bad as your or worst fears. These sets of charts are from Morgan Stanley. It was put out by Mike Mauboussin and his team. Everyone, by the way, every investor should read Mike Maubussin's research. I think he's fantastic. But this chart looks at the 20 companies that have grown very fast-growing companies, and looks at how many of those companies actually continue to grow fast into the future. And this, I believe, goes back to the 1960s, and looked at basically all the publicly traded companies. If you look at the dotted lines, which are lines that I added to the original chart just to help our viewers. So companies that have grown 20% plus over the past 3 years, over the most recent 3 years, about half of them, so the red dot, if you look at the red dotted line, about half of them over the following 3 years only ended up growing about, call it 6-7%. So that's half. So half of the companies that grew at 20% or more over the past 3 years only ended up growing at mid to high single digit over the next 3 years. If you look at the green dotted line, so what percentage of the companies that grew 20% or faster over the last 3 years and continued to grow at that rate for the next 3 years? It was only 17% of the companies that grew very quickly continued to grow very quickly into the future. So just statistically speaking, I mean, investing requires making assumptions, but those assumptions have to be grounded in data. And I believe statistics need to be respected. And so, if you are picking stocks, you just have to, and if you're attracted to really shiny, fast-growing, sort of the buzzy companies, you just have to be reminded that only 17% historically have continued to deliver the same kind of growth rate into the future, and more than half of them ended up only growing double digits in the following 3 years. If we go to the next slide, please. The next slide is about return on invested capital and profitability. This looks at the companies between 1985 to 2023, and basically looks at the spread between the company's return on invested capital and its cost of capital and their cost of capital. And the wider the spread, the more value you're creating, right? You're borrowing or you're raising capital at, say, 10%, and you're generating 20% in ROIC, means that 10% spread is something that you get to keep. So the wider the spread, the better. But this just shows that the median path of the ROIC and WACC weighted average cost of capital spread for U.S. companies is, you can see that drop rather sharply a few years after the IPO. What this basically means is that, excess returns over time, more often than not, get competed away because others see it and they want to enter the market and take some of that away from you. And so what happens is, it basically gets competed away. Again, there are companies that continue to sustain high levels of profitability and return on invested capital over a long period of time. But the vast majority of the companies see that get competed away. So if you want to extrapolate a company's high ROIC today and build it into your models, into the future, you just have to be really careful. If we go to the next slide. The next slide actually looks at, again, it's kind of similar to the first chart actually, but this looks at companies. This looks at how basically the sales growth over time naturally converges, whether you are a fast-growing company to start with. So, all these lines basically looks at how fast the company grew over the last 3 years. And there's a cohort of companies that grew sales at double digits and somewhere in the teens. There's a cohort of companies that grew sales over the last 3 years around 10%. There's a cohort of companies that grew it at sort of high single digit and then low single digit. And there's, of course, a cohort of companies that actually saw their growth be negative over the past 3 years. But if you take those groups and over time, if you take the average growth rates within those groups, they converge basically to the average of the overall universe. What this means is that whether you're starting out with high growth rates or low growth rate, the average company is going to see their growth rates kind of revert to the mean and converge to the average. So again, also something important to keep in mind. But this doesn't just look at companies that were growing really quickly. It also looks at companies that were actually growing slowly, and those companies also over time, often have a chance to, increase their growth rate, reaccelerate their growth rate to the average. So why does something like this happen? If we go to the next slide, please. The idea of reverting to the mean, it was actually, I learned this from the late Danny Kahneman by reading his books and his works. And he explains the reversion to the mean as the following. So extraordinary results are a function of skill and luck. That's how you deliver extraordinary results. And almost basically every great investor's I know agree that this is how extraordinary results are delivered. No one will tell you that extraordinary results are only the result of skill or only the result of luck. It's a combination of both. But the thing is, this period's results may be extraordinary because you had skill and some luck. But when you try to do that again the next time, yes, it's very possible that the skill will be repeated because it's something that you have, it's repeatable. But luck is not in your control. And almost by definition, luck doesn't happen every time. It actually happens rarely, which is why no matter how good a company is, if you've delivered extraordinary results for a certain period of time, for that company to continue to deliver extraordinary results over and over and over again, you basically need to have luck reappearing over and over and helping that company over and over and over again. Almost by definition, that doesn't happen. So it's just important. This was I knew this as a practitioner, but it was just important reminders for me, and so I wanted to share with our viewers to always remember that good things usually don't last, and be really careful before you extrapolate extraordinary good results of today into the future, because statistically the statistics are actually stacked against you. So again, it's possible, but just be very mindful.
Well, Dan, I think this just further highlights the need for perspective, especially in all the charts that you have. And the final slide that you brought up there regarding the reversion to the mean, that formula, I noticed that discrepancy between the exclamation point and the question mark after repeatable.
Right. Skill is, skill, I think it's fair to say, is repeatable. If you have a skill, if you're really good at something, if you do it again, you'll likely do pretty well, the next time and the next time and the next time, because it's something that you have and it's something that is in your control. But luck, that's out of your control. And so, is it repeatable? Probably not.
And perhaps difficult to quantify, right, when it comes to luck.
Right.
Well, so before I let you go, Dan, I know that you mentioned technology, and just based on the gains that we've seen this year, we know that the Mag 7 names, for example, have been driving a lot of the gains. And when we look at PE ratios for some of those names, can this growth continue, and what are the implications here as we head into 2025?
Yeah, tying this into what I was talking about just now, right? These companies have delivered extraordinary results for a very long period of time, but it's also important to try to understand, again, whether it was luck or skill, right? And for a lot of these companies, it certainly doesn't apply universally to, say, the Mag 7. But if you think about companies like Microsoft, Apple, Google in particular, in my view, these are companies that are really delivering, these are modern day, they're delivering modern day business and personal essentials. I've talked about that on the show before. But really, if you look at Apple, iCloud backs up my phone, but iCloud really is backing up my life, essentially, in this day and age, right? So it's really delivering a service that is essential to me. It really is a staple. If you look at Google, for my personal email, I use Gmail, and just recently I had to upgrade my storage because I was running out of storage. And to be honest, I don't even remember what I pay Google. I just know it's not much. The next time when Google says I'm only accumulating things in my Gmail, so I'm going to bump up against that limit again. And the next time when Google says I'm going to have to pay them a few dollars more a month because I've used up all the storage, what am I going to do? Am I going to say, no, I'm not going to pay and stop using Gmail, or somehow spend days and probably weeks going through my emails and deleting them to free up space? I'll just pay them a few extra dollars. But that's because it's, one, really essential, but two, also not cost prohibitive for me to do that. If you look at Microsoft, you know, my firm, I mean, we run on Microsoft, and if Microsoft increases the price next year, we're going to have to pay, because we're not going to say, like, we're not going to walk away from Microsoft. You know, if Microsoft increases prices, and if for whatever reason, if a company can't, like, if we can't afford that, let's say, before we say, oh, we can't pay the Microsoft increase, the premium coffee is gonna, you know, the premium coffee, the nice pens and the notepads, those are gonna have to go first, because those are nice to have but not essentials, whereas Microsoft really is. So these are companies that are selling essentials, really modern day staples. Like, you know, once upon a, I remember people would talk about business services sector as being pretty resilient. You know, certain segments of business services, because even in bad times, like, you still need to have your bathroom, you know, sanitized and maintained by Ecolab or something. You know, so it's a really sticky, stable, low volatility business. Well, Microsoft really has a similar position these days. And, you know, if your firm runs on Google, same thing with, you know, G Suite and such. So I do think that the businesses are really sticky, and therefore I think they will be able to continue to grow into the future. Whether they can deliver, like, really extraordinary growth rates, you know, if I actually apply what I just shared, you know, the reversion to the mean, probably not. But I also don't think the valuations of these companies are so demanding that they need to deliver really extraordinary results. I mean, there are exceptions, you know, maybe, you know, some are more expensive than others. But I do think that, generally speaking, they're valued not for perfection, but, you know, valued for results that are pretty reasonable. The future that I think is pretty reasonable, and that I kind of expect them to deliver. So that's sort of where I come out on, especially the Microsofts, the Apples, the Googles of the world.
Well, Dan, we have covered a lot of ground, not just in today's segment, but of course this year we've talked about cycles and technology, and I think perspective always helps versus looking at the short term here.
Right.
Well, thank you so much, Dan, for joining me today and for covering what's happening in the marketplace throughout the year.
Well, thank you. It was a pleasure to be here.
Thank you, Dan. And for all of you watching, that will do it for Global Money Talk live from the New York Stock Exchange. We're so excited to bring you daily coverage here on SamPro TV. And you can check out the show anytime on our YouTube channel by searching Global Money Talk. Thank you so much for joining us throughout the year, and we'll be back here in the new year. So happy holidays to everyone, and we'll be back in January 2025.